Which dividend stock is the best one to buy? Domino's, Raytheon, or Intel? I'm going to answer that question in this video, comparing these companies on 6 different metrics, starting with the dividend yield. So let's get right into it. Domino's offers a dividend yield of 1.1%. Raytheon offers a dividend yield of 2.23%. And up until a recent update, Intel was offering a dividend yield of 5.72%. But hold on, Intel slashed its dividend. It's now offering a dividend yield of just 2%. This is not included in the data just yet, but I'm following the company, and its recent announcement suggests that its dividend yield is now closer to 2%. And I'll talk about why that's the case. And if you've been watching my videos, it's something that I've been talking about for some time. So let's get to that point. So, what I have on this slide is the company's earnings per share in the purple and then the dividend per share in the orange over a trailing 12-month period. Okay? So, companies pay dividends out of earnings. And if earnings fall below where dividends are being paid at, then that raises the question if the dividend needs to be cut. And that's precisely what happened with Intel. So let's take a look at Intel first on the bottom. You see in the purple Intel's earnings per share, very healthy, above its dividend per share for a long time, until most recently its earnings per share absolutely collapsed, falling to $1.02, while its dividend per share was still at $1.46 over the trailing 12 months. So Intel tried to hold off on cutting its dividend because it thought, okay, maybe this decrease in earnings per share is going to be temporary, but it looks like it's longer lasting. The reason for the decrease in earnings per share is because so many people bought computers and electronics during the earlier stages of the pandemic that now they're not buying them anymore. Right? In other words, if you bought a computer in 2020 and 2021, you're probably not going to need another computer until 2025 or 2026, right? You use computers, on average, the average consumer uses a computer for 4 to 6 years. So there was a lot of purchases in 2020 and 2021. That means there's a big gap between the next big upgrade cycle. So Intel is likely going to experience decreased earnings per share over the next 2 to 3 years. And it doesn't help that Intel and its competitors all ramped up production because consumer demand was soaring and they were having a hard time meeting that demand, so they ramped up production to try and meet it. And so now they've got too much inventory that they're needing to cut prices on. So for all those reasons, Intel's earnings per share fell and it needed to slash its dividend. That's why I look at this metric here, the earnings per share and the dividend per share, because it tells me how sustainable a company's dividend per share is and how likely is it to be cut. Raytheon, meanwhile, is experiencing the opposite trend of uh, Intel, in that its earnings per share is rising and its dividend per share of $2.16 is about 66% of its $3.52 earnings per share. However, over the next couple of years, Raytheon's prospects are excellent. Militaries and countries worldwide are increasing their spending on um, military equipment, I would say, because of this increasing aggression being shown by Russia and its invasion of Ukraine. And so Raytheon is capturing a lot more orders, a lot more sales at higher prices, and it's going to likely see that for the next couple of years. Domino's, meanwhile, has been growing its earnings per share very nicely over the years, and its dividend per share of $4.40 is roughly one third of its earnings per share of $12.54. Domino's is experiencing mixed prospects right now. It thrived at the pandemic's onset. Ordering pizza at home was a no brainer because restaurants were closed and you could hardly find anywhere else to eat if you wanted to eat out. Domino's thrived as a result, but now that tailwind is slowing and its earnings and its sales are likely to flatten. The next thing I wanted to look at is revenue growth. And looking at these three companies on revenue growth, you can see Intel's collapse here, falling from revenue growth of 20% at the peak all the way down to negative 31.6%. So Intel's in all kinds of trouble right now. Raytheon, meanwhile, 6.15% revenue growth, higher than Domino's at 3.65%. Over the next 2 years, I suspect Raytheon to have the best revenue growth over these three companies. The next metric I wanted to look at is operating profit margin over the trailing 12 months. And this is critical because this shows me how profitable the company is on its sales, right? How profitable the company is at running its business. And looking at this metric, I see Domino's at a very healthy 16.93%, Raytheon at 8.03%, less than half of Domino's, and Intel is collapsing at just 3.7%. Now, Raytheon's been experiencing a downward trend of recent years as countries have, NATO countries has been hesitant to increase their military spending over recent years, but now they've all signaled that they're increasing their military budgets. So it's gonna be good for Raytheon over the next couple of years as their weapons technologies are going to be in high demand. This is crucial also. Looking at the cash flow of operations to sales, this shows me how good a company is at turning their sales into cash flow from operations. And while Intel was far behind in many other metrics, the company has done an excellent job in turning sales into cash flow at 24.48%. The main difference between Intel's profits and sales turning into cash flow is the significant depreciation expense the company experiences um, on it needs to account for it on its income statement, but that's not it's a non-cash expense, so it allows the company to still generate cash flow even though the accounting may not show profit as high of a ratio in profitability. Raytheon and Domino's, very close, 10.6, 10.5% for each of them. So I would say a tie between those two. Finally, I wanted to look at valuation to determine which one of these three is the best one to buy right now. Now, I know a company can be a better performing company over its competitors, but if the stock is way overpriced, I'm not going to want to buy that stock even though it's a better company, right? It just because it's better doesn't mean I'm going to be willing to pay any price for that stock, right? And the way I measure how expensive a stock is by looking at the price to earnings or the price to free cash flow. These valuation metrics tell me what I'm getting for my money, right? It's not just the price of the stock per share, it's what you're getting from that. And I teach finance and economics at a university, and the example I give my students is with a box of cereal. I tell them, look, you can have two boxes of cereal, right? Both of them priced at $5, but one of them has 24 ounces of cereal inside, the other one has just 16 ounces. So the price per ounce is much better at this other one, even though they're both priced at $5. That's how I like to explain looking at market stock prices, right? So even though the stock prices could be similar or higher, it's what you're getting for that market price that you're paying. How much earnings are you getting for that share price that you're paying? How much cash flow are you getting for that share price that you're paying? So even if the share price might be high, if you're getting much, much more, then it's worth it because the price per earnings is lower. And so that's what I have here, the price per earnings. And looking at this metric, Raytheon is the cheapest at the forward price to earnings of 19.6. Next is Domino's at the forward price to earnings of 22.98. And finally, Intel at a forward price to earnings of 48. So, Raytheon, I was talking about how it's got excellent prospects over the next 2 to 3 years, and longer term, it's got good prospects as well. And it's trading at it is trading at the cheapest valuation according to this metric. So if I had to pick one of these three dividend stocks to buy right now, I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I would pick Raytheon Technologies as the best dividend stock to buy right now. All right, so that's all I've got for this video. If you enjoyed this one, I'm going to link to 2 more of my videos at the end. I think you will enjoy those as well. So please click on one of those and I will see you over there.